Hello everyone, welcome to Apex Capital, and today in this video we will be trying to analyze this company Amara Raja Energy and Mobility Limited. So this is a small cap company and it's part of the Nifty Small Cap 100 index as well. The market cap of the company currently stands at about 17,000 crores. It's a bit on the higher side as compared to other companies in the small cap space, right? Now, before going into the numbers and all these ratios, let's try to understand first what the company exactly does. What business is it exactly in, right? So, Amara Raja Batteries is part of the Amara Raja Group, and it is one of the largest manufacturers of lead acid batteries for both industrial and automotive applications in the Indian battery storage industries, right? Company has prestigious OEM as its clients. The company's industrial and automotive batteries are exported to over 50 countries across the globe. So what are lead acid batteries? This is the first question that comes to our mind. So lead acid battery is basically a type of rechargeable batteries, right? It is used to store energy. Now, the most common use case of lead acid batteries is you will find are automobiles, two-wheeler, three-wheeler, four-wheeler, and even commercial vehicles like trucks, buses, pickup trucks, etc. rely on batteries to fire up their engine. All cars have a battery. Now, that battery is basically the lead acid battery, and most these companies, even Maruti Suzuki, Honda, Hyundai, most of them purchase these batteries from Amara Raja Batteries Limited or its peers like Exide Industries, etc. Right? So there are 2-3 big manufacturers, battery manufacturers in India. So Amara Raja is one of them, and in fact, it is the market leader in this space. Now, yeah. So if we take a look at their revenue mix, 96% of their revenue in FY25 came from lead acid batteries, right? It is the largest lead acid battery manufacturer for industrial as well as automotive application in India's industry, and remaining 4 to 5% of their revenue came from new energy business, which is basically a fancy term for lithium ion battery, right? Lithium ion battery cells, battery pack solutions, and chargers for electric vehicles, etc. All of these things rely on lithium ion battery technology, while lead acid batteries, which is the major almost 95% contributor, they are already the market leader in that space. Now their client list includes brands like Maruti Suzuki, Tata Motors, Hyundai, Honda, Eicher, Mahindra, Ashok Leyland, etc. Right, and they're also the largest exporter of these automotive batteries. Right, they manufacture batteries for two-wheeler, three-wheeler, four-wheeler, and commercial vehicles as well. As far as industrial clients are considered, Amara Raja is the pioneer in manufacturing valve regulated lead acid battery VRLA battery, and they offer these services to various clients come from UPS industry, telecom industry, railways, etc. Again, it is a market leader in the telecom sector and the largest exporter of VRLA batteries. So if we take a look at their earnings presentation, you can see that in the lead asset business they have automotive clients as well as industrial clients. So automotive clients, we already talked about Maruti Suzuki, Tata, Honda, even Mercedes, Ashok Leyland, etc. And in the industrial client list they have BSNL, Airtel as a telecom clients, uh, Indian Railways, then they have Infosys, Fuji Electric, Legrand. So their client list is quite diverse as we can see here, right? So basically electronic equipment, this industry is basically electronic equipment manufacturing industry, right? So moving on to their pricing ratios, we can see that the price to earning ratio of this stock is about 23. Now 23 is not very low but not very high either, so it's sort of okayish number. uh, what's more important than the price to earning ratio is the price to earnings growth ratio. So the peg ratio is at 1.27. Now again, this is not very high number, but at the same time not very low either. In fact, it tells me that the company is a bit richly valued, right? Anything above than 1 tells me that the company is richly valued. 1 is the typical fair value sign as far as price to earnings growth ratio is considered. Now price to earnings ratio we already saw. Now price to book value is about 2.2. Now what does price to book value tell me? Price to book value tells me the safety net which I have before investing into a company. So the book value of the company itself is about 423 per share, and the stock is currently trading at 931 per share. That means the worst case scenario, right? If the company is supposed to be liquidated tomorrow and assuming that the total assets of the company are more than the total liabilities, then the book value is what I will be, as an investor, will get. So that's what book value tells us. So a low price to book value is always good. In fact, price to book value ratio should always be lower, lesser than 5 only, and 2.2 ratio is pretty good enough. Price to sales ratio also about 1.3. It is tells me that the company is a bit undervalued only. So that's again a good indicator. Now, talking about the returns the company has generated, the return on capital is great. Any return over 15% is considered great. So return on capital of 16% is good enough. Return on equity is a bit on the lower side. It is about 12%. Now, return on equity, the formula for return on equity is net operating profit after taxes divided by the shareholders' equity. Well, the formula for return on capital is operating income or EBITDA divided by uh, total the shareholders equity plus the this total debt, so that comprises the total capital employed. So the company is generating a good return on capital while the return on equity is on the lower side. This tells me that their operating income is good, but their net operating profit is not so great. So that we can all that is also visible here, that the operating margin of the company is okay at 11.2%, not high but not very low either, but the net profit margin is 6.5%. So this is a bit on the lower side. Now later when we study their financial statement, we will see what's the reason, right? Since their return on equity is low, their return on assets is also low at about 9%. And next we see the debt to equity ratio is at 4%. So that's pretty great. The company has very low debt, right? Dividend yield is about 1% and dividend payout is 20%. So that's a great number. That means 20% of their earnings last year were given to the investors as dividends, right? So sales growth for the last 3 years has been about 14%. So that pretty much covers all the important metrics. Now let's dissect the company a bit more and study their financials. Okay, one thing which we forgot to discuss about is their median PE ratio. So the current PE ratio of the company is 23, right? But for the past 3 years, their median PE ratio has been somewhere around 19.5. And for the past 1 year, their median PE ratio has been somewhere around 21. So currently they are trading at 23, which means that the company is slightly overvalued compared to their median valuation, but still close to the median valuation only. So there is no significant de-rating risk in near short term. Uh, the price to earning ratio is also did also make a high of about 24.6 in November last month, but currently it trades at PE of 23. All right. So these are the machine generated pros and cons. So as you can see, the company is debt free, maintaining a healthy dividend payout, right? On cons, we have low return on equity of 13.5%, as we talked about already. Working capital requirements have reduced. So again, this is not very important, but okay, anyways. Then we have peer comparison. For peer comparison, I prefer using Tejori Finance's interface. So as you can see here, these are all the peers in the electronic equipment manufacturing industry. Basically, these are all also battery energy storage manufacturers. So Amara Raja, HBL Engineering, Exide Industries, Eveready Industries, Indo National, Panasonic, etc. Now you can go through all these companies. I have already gone through, but my conclusion was that Amara Raja Energy and HPL Engineering are the only two stocks worth owning out of these as of now in this industry, right? Exide Industry, as you can see, that the return on capital and return on equity is even worse than Amara Raja, but their PE ratio is almost double of Amara Raja. So there's no point in investing in Exide Industries for now. Eveready Industries are posting good returns, but their sales growth is not really great, right? As you can see, the sales growth for Eveready Industries is barely 3.6%, while their price to earnings ratio is 32.3. This means that the price to earnings growth ratio is very high at around 1.5. So Eveready is also not looking like a very good investment. High energy batteries, Indo National, Panasonic, these companies also are not posting very good results. You can go through their financials and some or the other problem is there, right? As of now, I think Amara Raja Energy is a good value for money bet and HBL Engineering is a good growth bet, right? Apart from these two companies, all companies have some or the other problems. Amara Raja Energy and HBL Engineering. Focus on these two stocks, study them well, and make your own decision, right? Now, So that's about peers. Now moving on to their financial statements. So this is the quarterly result. We are more concerned about their annual statement, right? Annual P&L statement. So as you can see, they have shown a decent sales growth, 20%, 12.5%, 10%. So their compounded sales growth for the past 3 years is about 14%, right? That is the CAGR growth in their top line. So that's a pretty great number, I would say, right? And their compounded profit growth has also been great at 18%. So that's a phenomenal number. Now talking about their operating margin, it's about constant at 12 to 14%, 13%. Although in the trailing 12 months their operating profit has stayed about 11%. But in the latest earnings call, if I'm not wrong, the management did address this query on operating profit, and they're optimistic that this 11% operating margin should improve to their usual 13 to 14% numbers in the coming quarters. So I'm optimistic about that. Now what else is there? Interest cost is not that much, since the company is almost debt free with barely 4% debt to equity ratio. The interest cost is also pretty low. The main component, the biggest line item which you can see here is depreciation. So depreciation itself is taking away 568 crores out of their EBITDA, which leaves us with profit before tax of 12-15 crores. The tax rate has been constant for the past few years, and the net profit comes out to be 900 crores. Now 900 crores is no small number by any margin, right? It's a big number, no doubt, but compared to their operating profit of 1400, almost 1500 crores, 900 crores of net profit does feel a little bit small, right? So this is primarily the reason why their return on equity is lower compared to the return on capital employed. The formula for return on equity is net operating profit after taxes divided by shareholders equity, right? So here we are concerned with the net operating profit, which is low, so their return on equity is also low, while return on capital employed is calculated by EBITDA divided by total capital employed, which is shareholders equity plus the total debt. Now since their EBITDA is much higher than their net operating profit, their return on capital is also much higher than return on equity, despite the debt to equity ratio being very low at 4%. So this is a bit of a concern, which I can see in their financial statements. Apart from that, everything looks good. The profit growth is great, 18% CAGR growth, sales growth of 14% CAGR for the past 3 years. So these all things are great. Balance sheet also no problem, as the debt itself is very low, so low borrowings and low interest cost. Nothing to worry about much here. Cash flows and these ratios are not much important. We have already covered cash flow in great detail in the discounted cash flow state DCF model, which we have prepared. So we will talk about the cash flows there. Coming on to the shareholding pattern, right? So shareholding pattern is important metric. So as you can see, the promoters stake has been constant for like past 2-3 years. It went up from 28% to 33%, almost 33% in FY24. After that, it has stayed constant. Similarly, FII on the other hand have been on a selling spree. They used to hold 36% of stake in FY23, but now it has come down to 18%. So they have almost halved their stake, right? Reduced by 50%. DIIs on the other hand have been buying the stock in small quantities, and they have raised their stake from 9% to almost 16%. So basically, all I can make from here is that FIIs have been selling since past 3 years, and promoters and DIIs have bought from the FIIs. Public stake is more or less. Public has also been on a buying spree, a bit of a buying spree. The stake has gone up from 26.5% to 33%. Right. So that's all you can make from the shareholding pattern. Now, regarding the credit rating, as you can see here, they have been rated by CRISIL as AA positive. So that's a very good rating. This means their debt profile is healthy, and they should be able to get further debt if they want at reasonable interest rates. Alright, so now let's move on to the discounted cash flow valuation of our company. So this is a DCF model, which this is my own DCF model which I have prepared, and I use it quite frequently whenever I'm confused a bit about the valuation before investing into a company. So all these line items are derived from the financial statements of the company, except three most important or we can say dynamic line items. These are the revenue growth rate or the growth lever, the EBIT margin or the profitability lever, and the sales to invested capital ratio, which tells us about the efficiency of growth lever. So these three line items uh, I put my own estimates, right, for regarding the future of the company, and based on these estimates, by discounting the cash flow, you can get a fair value for the company, right? So for revenue growth rate, I have assumed a high growth for the next 5 years. Thereafter, the growth rate comes down to the 5% stable growth rate in perpetuity, and this is close to expected long-term Indian GDP growth rate. So basically, for the next 5 years, I have assumed a 10 to 15% growth rate, right? And after 5 years, the growth rate converges down to 5%. Now, how did I come at the 5% number? So see, the GDP growth rate of India as of now is about 8%, right? It recently came out and made a lot of news. So 8% is the Indian GDP growth rate as of now. Even after 10 years, India will be a developing economy, right? So in the worst case scenario, a 4 to 6% or even 7% GDP growth rate is possible 10 years down the line. So 5% is a fairly conservative estimate, although usually people take a 3% terminal growth rate for their valuations, but that's a norm in western countries, right? And as far as India, which is a emerging and developing economy, is concerned, I guess 5% terminal growth is a reasonable expectation, since even after 10 years Indian GDP growth rate will be significantly high, right? So that's about the growth lever. Then in terms of EBIT margin or the operating margin profitability, now OPM percent here refers to the EBIT percent. On screener, what you see as the operating margin, this is the EBITDA margin. In case of my model, OPM means EBIT margin, earnings before interest and taxes. Depreciation is not part of it. Hence, you will see that the operating margin is a bit lower than the EBITDA margin. The EBIT margin is 8.5%. So for the next 5 years, I have taken the EBIT margin to be around 8.5%. Thereafter, the EBIT margin converges to the industry average, which is 9.18%. So 9.18% is the Indian industry average EBIT margin, basically of the electronic equipment manufacturers. So current it stays for 8.5% for the next 5 years. Thereafter, increases to about 9.18%. Finally, the sales to invested capital ratio, which tells me the efficiency of the growth lever. Basically, what it means is that for every dollar of capital a company generates, how much revenue it generates, right? That's what sales to capital ratio tells me. So for example, if the sales to capital ratio is 2, then that means that if company generates $1 of capital, then it creates $2 of revenue for that $1 of capital. So that gives me a sales to capital ratio of 2. So in case of our company, the sales to capital ratio has varied from 1.88, 1.96 to even 1.72 and 1.65 in the trailing 12 months. So the industry average in India is about 1.75%, and so I have taken for the next 5 years the sales to capital ratio to be at 1.75%, right? Since our company has also maintained good efficiency. After that, in the terminal year, I have assumed that this sales to capital ratio would improve to about 2. Now, why? Because in India, the sales to capital ratio is currently 1.75%, but in mature markets like the US, there the companies in this same industry, in the electronic battery manufacturers, have a sales to capital ratio of more than 2. Right. So it's reasonable to assume that 10 years down the line, when our own companies have matured, right now the battery manufacturing space is quite nascent in India. So 10 years down the line, it's reasonable to assume that our companies will have better efficiency. So similar to US based companies, our sales to capital ratio should also improve. That's why I have arbitrarily chosen a number between 1.75 and 2, that is I have chosen 1.9. So what I have assumed is the sales to capital ratio would converge, would go higher and converge at a somewhere around 1.9. So these are my assumptions for the growth, the profitability, and the efficiency of growth lever. Right, based on these and some other metrics like the risk-free rate comes out to be 6% because the Indian bond yield is about 6.6%, and the sovereign CDS credit default risk for India is about 0.6%. So the actual risk-free rate for Indian markets comes out to be approximately 6%. And then this is the beta which you can get from Yahoo Finance, and after doing all these calculations, you will find out that the average cost of capital, weighted average cost of capital for our company comes out to be about 9.25%. So using this as the discount rate, the value per share comes out to be 988.21. So 988 basically is the value per share which I get from my model. And if you use a bit higher discount rate, let's arbitrarily choose 10% as our discount rate, then the value comes out to be about 800 rupees per share. If you take an even higher discount rate like 12%, then the value comes out to be around approximately 500 rupees per share. So based on the how conservative you chose the discount rate, you will get different values. I typically take the discount rates to be 10%, and that tells me about a value of 800 per share. And if I use the capital CAPM model to calculate the discount rate, then it comes out to be about 9.25%, and that gives me a share value of 988. So uh, as of now, the current market price is about 920, so there is a good 7.3% potential move as our model predicts. And if you buy the share at 988 rupees per share, this implies that we will make the cost of equity as the yearly return on this stock. Now, what is the cost of equity as per our model? The cost of equity for Amara Raja is about 9.435%, 9.4%. So that is what you will make as a yearly return, in addition to the 7.3% of move which our model predicts from the current market price. All right. So that's for the DCF valuation. Now, yeah. So this is a bit of a summary of the of all the concerns which I have regarding the company. Yeah, the company posts high depreciation due to which their EBITDA margin is high, but the EBIT margin is but the EBIT margin is low, right? That's the difference. And this leads to a difference between the ROC and ROE. So that we already talked about at the start of this video. Then revenue mix, we already have discussed that 95% of their revenue comes from lead acid business, while 4 to 5% of their business comes from new energy business, which is the lithium ion batteries. Now the interesting point is that this new energy business has seen a 50% year on year growth in the last financial year, right? In the last financial year. So that's a pretty interesting observation, because if we see, the lithium ion battery industry is valued at around 2.5 to 4.2 billion dollars in 2023, right? And it is mostly the demand is mostly driven by EVs and renewable energy, right? And with the current forecasts predicting that by in the next 7 to 8 years, this market will be valued at, the total market will be, addressable market will be about 7 to 19 billion dollar. That means in just one decade, the this lithium ion battery market will grow by 5 to 10x, right? It will grow by manifolds, and it's quite a great opportunity for already established players to grow their top line. So basically, the drivers for this demand are EVs, largest application propelled by rising EV sales, and even government initiatives for electronic vehicles. Then there is renewable energy storage. So all these solar power plants and solar power installations at home, you see, they all rely on lithium ion battery for energy storage, right? Even windmills rely on lithium ion battery storage. So this renewable energy, the more there is a push for renewable energy, you will need more renewable energy storage. So eventually this battery energy storage systems powered by lithium ion batteries will see a huge spike in demand in the coming decade. Next, all consumer electronics like these smartphones, laptops, and smartwatches, etc., all these are powered by lithium ion batteries, right? So again, there's also a big demand from this industry. Then there's also regulatory support and government support and regulatory push using this product linked incentive scheme, PLI scheme. So all in all, basically this new energy business, what they call this lithium ion battery business, which is only 5% of their revenue for now, will see a huge growth in the coming decade. So it would be interesting it would be interesting to see how this plays out in their top line growth. Next up, company expects the lead acid battery export volumes to grow. Okay, so we have already talked about that a good chunk of their revenue comes from the exports. You can take a look at revenue mix here. So yes, so about 87%, 87.5% of their revenue comes from India, while the remaining 12.5% comes from the rest of the world. So they have good export export base. Although if you listen to their earnings call, you will find that their in previous few quarters their export volumes have remained subdued due to the tariff uncertainties, right? But in the coming quarters, since the tariffs, the whole tariff situation has cooled out, and now it's clear the export volumes will see an increase. Alright, so that completes the discussion, and now what's the final verdict? So, in general, I am bullish on this whole electronic equipment manufacturing industry, particularly the battery energy storage system manufacturers, right? Because as we discussed, this whole battery storage system has a lot of potential growth, and can expect a lot of potential growth in the next decade. So, of course, there are a lot of multiple players like Amara, Raja Energy, HBL Engineering, Exide Industries, Panasonic, so on and so forth, no doubt. But at current valuations, only two of these make sense to me: the Amara Raja Energy and HBL Engineering. Now, HBL Engineering we will talk about in some other video. As far as this video is concerned, we have already discussed the valuation, the different pricing ratios, and we have gone through the financials of Amara Raja Energy, and I do think it's a good bet to make at the current valuation. Of course, do your own due diligence before making investment decisions. So that's it for this video. Thanks for watching, and see you in the next one.